Hello, everybody. Welcome to this Derivative Virtual Trading Challenge 2024 webinar that is titled Swing Trading for Maximizing Opportunities in the Futures Market. My name is Shane Chu. I'm the moderator for this webinar. So this webinar is brought to you by Bursa Malaysia Derivative in partnership with broker partner Afin Huang Investment Bank. So today, our topic here is about swing trading. How do we do swing trading in the futures market? So we have invited two speakers here to share with us on this topic. We'll begin with the first speaker, Mr. David Low, the Managing Director of Top Infinity, to talk about swing trading. And then the session will be followed by Mr. Lim Eng Wee, who is the Assistant Vice President from Afin Huang Investment Bank, to talk about Afin Huang's offering as well as how you can benefit from joining this derivative virtual trading challenge. Now, before we begin, disclaimer, whatever we share in this session is only for educational purpose. So we in no way that we give any recommendation for you to buy or sell any listed derivative that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all your investment risk. Now, allow me to briefly introduce our first speaker. He holds the position of Managing Director at Top Infinity's Neighborhood, which is a proprietary trading firm that focuses on trading a range of financial markets, including global commodities, currencies, equity indices, and financial derivatives. Along with this, he served as a Managing Director of New Pinnacle Trading Academy. He has 25 years of experience in Bursa's listed derivative industry. Before starting his own consultancy, David held leadership positions in futures broking divisions of major investment banks in Malaysia. He served as the president of the Malaysian Futures Brokers Association between 2018 and 2019. So it's none other than Mr. David Low. So David, how are you today?
Fantastic, Shane. Thank you for that fantastic introduction.
All right. So we can't wait to learn from you about swing trading. How do we do that in the futures market? Where is the exit point and where is the entry point, right? So without further ado, let me just hand over the session to you.
Thank you, Shane. Just let me share my screen now. Okay, is everybody having a correct view of my screen? Looking good there?
Yes, perfect.
Okay, and welcome everybody to this session of the DVTC, Derivatives Virtual Trading Challenge webinar. Tonight's evening's topic is swing trading for maximizing opportunities in the futures market. What I'll be sharing with you tonight will be how to get in and out of the market in terms of swing trading. Okay, swing trading is a type of short-term trading. We will get into but before we get into that, let's just move on to my slides, see whether that's moving and working. Okay, that's working. Disclaimer, I think you saw that from Shane already. We should not delve in this. Okay, that's myself, and Shane has ably introduced me. So let's move on. And this is what we will be sharing tonight. The first is to learn the 6 critical concepts about trading that you must know to succeed. Okay, I understand that in this audience there are different types of levels of traders. Some of you may have not even started. Okay, some of you may be students. Okay, and some of you may be a seasoned trader as well that join us to learn some new ideas, right? So, but there are certain concepts in trading that's very important to know. Okay, in order to succeed. And for those seasoned traders, it's also a good reminder as well in terms of whether we miss out some of these points in our trading. Okay, so we'll delve into these 6 critical concepts about trading. Then we'll look into the market timing tactics. Okay, I'll share with you a method that I personally use as well for our trading. Okay, how to enter and exit, where are the entry points, where are the exit points, and where are the stop losses as well, when to do that. Okay, and we also will be sharing with you a method of how to implement position sizing technique, which is an important part of trading, which is money management and position sizing. And that is to use to maximize profits. Okay, so these are the 3 main things that we will be covering this evening. right? So let's talk about the what and whys of swing trading. So what is swing trading, right? So before we get into swing trading, I just wanted to, for the benefit of the newer people who are less, what do you call that, familiar with trading, okay, we need to differentiate between trading and investing, right? So in investing, the purpose is actually to build wealth over an extended period of time, okay, through buying and holding a portfolio of investment assets. Right. So in the stock market, if you're investing, you're looking for a long-term view. Okay, you're buying and holding, getting dividends and all that from holding the shares. Okay, or even some other types of assets. So the period of holding is long. Okay, it's long, right? And the return expectations from investing is usually between 10 to 15% per annum, right? So that is the return expectations. As contrasted to trading, right? Trading is the buying and selling of stock indices, commodities, currency pairs, and other instruments with the goal of generating returns that outperform buy and hold, right? So buy and hold is very traditional. You buy and then you hold that asset for long term. But we are trying to do better, right? The traders try to do better. So their holding periods are shorter, okay, and their return expectations potentially, you're talking about not about 10 to 20% per year, but the expectations could be 10 to 20% or more per month. Okay, so that's what gets a lot of people interested in trading, in the potential of gaining that kind of returns. Okay, so but we will go through the 6 critical concepts. If you want to make this sort of money, right, you need to be able to master the 6 critical concepts, okay, which we will cover later. So now we differentiate between trading and versus investing, and this is very important, right? This differentiation, right? And we go in and look at what swing trading is. Okay, so what is swing trading? Now, swing trading is a style of trading. Okay, there are many styles of trading, right? And swing trading is one style. Basically, in terms of swing trading, the trader aims to capture short to medium term gains, okay, over a period of a few days to several weeks. Okay, so that's the holding period for swing traders, a few days to several weeks, right? Whereas later we'll see long term what you call it, investing is different, or even position trading is different, right? So what the swing trader aims to capture is the swing in the markets. So if you identify a trend, okay, you have identify a primary trend. The swing trader wants to catch the move up and down. Let's say, for example, if it is an uptrend, right? The swing trader wants to catch the up and down because markets don't move up or move down in one single line, right? One in single straight line. So it moves in waves. So swing traders try to catch these swings up and down, right? So that is what we call swing trader, right? And of course, in terms of relative to investing and relative after, you'll see in position trading, it's holding between a few days to several weeks. Okay, so what chart time frames do swing traders use? Normally, they look at charts from 60 minutes to daily charts. Right, so this is a time frame. If you're looking at chart, and later when we look at charts, we'll look at 60 minutes and daily charts. So this is a time frame because for swing trading, if you use 60 minutes charts, a trend will tend to move about 20 times your time frame, right? So 60 minutes, that means what do you call that? 60 minutes with 1 hour multiplied by 20. So the movement or the swing or trend that moves between the next 20 hours and also the next 20 days. Okay, so that's why it's a few days to a few weeks. Right, so this is what is swing trading, and we will contrast it with long-term position holding. What is long-term position holding? Okay, the difference is in long-term position holding, you're looking at a holding period between 4 weeks or longer, right? In which you're either trying to catch a large price trend or the primary trend. Okay, so for those long-term position trading, they look at daily charts, okay, as their reference, or they look at weekly charts for their reference. So you're talking about the weekly chart. If you're looking at a weekly chart, you're looking at a trend that can last perhaps even for half a year, right? For 20 weeks. So that's about half a year, right? Whereas in short-term swing trading, right, 2 to 5 days to several weeks, that's normal holding period. Right? So now, what about the day trading? You may ask, okay, day trading, right? Okay, let's look at day trading. What is day trading? Now, day trading is very different from swing trading and also for position trading, because day trading, the trader does not hold his position overnight, okay? Overnight, that means to the next trading day. So you're basically buying and selling within the day itself, right? So this is the short holding period, okay, from a few seconds, okay, if you're a scalper in terms of day trading, to a few hours. Okay, so there's no holding, there's no extending positions after the market close. That's the rule of a day trader. Okay, they never carry positions over to the next trading day, right? Now, the objectives is even shorter term in terms of they look for the daily range short-term fluctuations. And the chart they look at could range between a very short-term 1 minute to 60 minutes, right? So this is day trading. I wanted to contrast it so they can see the three different styles as well. Later, we'll give you a chart to summarize that, right? But day trading is actually a topic I covered, I think, last year in DVTC as well, okay? But I want to let you know that day trading requires high skill, right? So day trading is, in fact, the skill is the highest, okay? You have to be the best, okay, when it comes to day trading. Because why? Because it takes a very, very what do you call that, heavy burden on your decisions, right? You have to make decision fast, okay? So some people it's very taxing or very tiring to make decisions every single 5 minutes or every single 15 minutes or every hour, right? So day trading is stressful in that sense that it takes a lot from your psychology, right? So position trading and swing trading is, I wouldn't say more relaxed, okay, but your decision, your time to make a decision is you can take a bit more time because you're looking at hourly charts, okay, or daily charts. So in that sense, it's not as intense as day trading, right? So it's a good what do you call that, way to start trading, especially for those who are doing live trading. Okay, you're actually trading and you're carrying a job by the side as well. So trading is your part-time thing, okay? Although it's a part-time thing, it could be a very serious thing as well, but it's part of your investment or part of where you want to gain extra what do you call it, or build up your nest egg or your wealth. So you do trading by the side while you have a full-time employment or a full-time business, right? So swing trading has this very good compromise, okay, in terms of you get short-term moves as well as it's not so taxing, right? So that's one of the advantages of swing trading. Okay, so this is a very, very good chart in the sense that you see all types of trader styles, okay? We spoke about day trader, okay? And right at the bottom is the scalper as well. Scalper is also a day trader, but very, very fast in terms of their time period, okay? So what are the characteristics of a day trader, okay? You need to have quick decision making. That's what we said just now, right? You have to make a lot of decisions because those decisions to buy or sell, to take profit or cut loss comes very, very fast, depending on what the time frame you look at, okay? And most of the day traders are very technical focused, right? They look at charts. Charts is mainly their decision trading tool, right? They make decisions using chart, right? Holding period, of course, within the same day. And the strengths that you need to be a day trader is you need to be able to thrive under pressure. You need to be able to adapt quickly. You need to be able to change gears quickly, right? And consider day trading if you enjoy fast-paced trading, right? So this is the style for people who like fast-paced trading. What about swing trading? Okay, swing trading, the characteristics of that swing trader is you're more patient. Okay, you look at more into trend identification. Okay, so holding periods, we already said few days to a few weeks. Okay, and what strengths? Okay, what are the strengths that you need for this? Okay, you must be able to spot the medium-term trends, of course, right? That's strength. And consider swing trading if you want to balance between speed and analysis, right? So because analysis, you need a bit of time to analyze, okay? So it's a very good balance between speed and analysis, right? So swing trading, that's why it stands right in middle between day trading, scalper, and position trade, right? Whilst the position trader is the one that has the long-term vision, has perhaps a more fundamental focus, right? So a position trader will look at different fundamental news or fundamental factors, and he can still, of course, be a technical trader terms of his timing, okay, but he tends to put in more factors like fundamentals into the decision making, right? So he could hold the position for months, 2 years, okay. So the strength, what type of strength you will need for that kind of trading is you need to be able to understand macroeconomics, okay, and you need to be a very patient person as well, because you're basically riding a long-term trend, and there's a lot of ups and there's a lot of downs, okay, but you're still riding the trend, right? You need to be extremely patient, okay, and consider position trading if you are very comfortable with longer trades, right? Now the scalper, the scalper is the most impatient of all, right? He likes to make a rapid decision making. Is very short-term focus. His trades are between seconds to minutes, okay? And his strength is he must be able to handle high frequency type trading, okay? So for these type of people, consider it if you are very detailed and very quick, okay? You're detail oriented and very, very quick, right? So this shows you in one chart what types of styles, again, and ask yourself what type of trader are you, right? So consider what type of person you are, what strengths you have, okay, and what are the characteristics of each style of trading. Okay, so this is a very, very nice slide to show and perhaps discover yourself as well. Okay, we move on now to the 6 critical concepts of trading. After understanding the differences between trading and investing and the different styles of trading, let's talk about this very important 6 concept. The first is this, right? Trading is serious business, okay? Now, if you go into trading, okay, and we're talking about trading with live money, okay, you have to be very serious, okay? If not, trading, especially if you're trading leverage products like futures and options, okay, if you don't take it seriously or you take it as a game, most of the time you will lose money, right? So you need to take trading as treat it like a real business, okay? So when you have a real business, you have to have a trading plan, right? You have to plan out what you want to do, okay, what types of instruments are you want to trade, okay, what style you are, what type of capital do you have as well, right? So trading is serious because it's not investing, right? We already differentiate that, and of course it's not gambling, right? And it's the third one is very important as well. It's not easy money, it's tough work, okay? It's not that the money cannot come in easy, all right? If you're highly skilled, it can come in like water, right? But then, okay, it needs to be traded seriously because it's a skill that you need to acquire, right? So for those of you who are thinking of trading full-time, right, one of the main considerations is in terms of the capital, how much living expenses do you have to set aside, okay, for perhaps 1 year, okay, or 2 years. You need to be able to cover that, okay, because initially when you get into trading full-time, okay, like last time I started after I retired from corporate work, I went to full-time trading. I had my living asset expenses covered. I know I can take 1 year, 2 years off, not having a full employment or not doing any other business to concentrate on full-time trading. So for those considering trading full-time, this is a very important point. Make sure you have living expenses, okay, and this is besides your risk capital, okay. Your risk capital is different from your living expenses, okay. So have this reserve funds between 12 to 24 months before you consider quitting a job and then go full-time trading. It's very important, okay, because you have even in trading you have your operational costs, you have your screen costs, your market data costs, your charting software costs. All these takes money as well. So it's really like a business and it should be treated like a real business, okay. So it's critical concept number 1, okay. So then don't take trading as a game, okay, unless you're just playing a game, right? But once you start with live trading with real money, it has to be serious business. Okay, number 2 is this, and this is very critical for even beginning and seasoned traders as well. Seasoned traders also sometimes forget this particular point, okay? Trade the reality of the market, okay? So what is the reality of the market, okay? The reality of the market is, we have to accept that no one can predict the markets with any true consistency, right? You may have short-term be able to predict a market momentum move, right? But in the long term, okay, no one, okay, we need to accept that can predict the markets with any true consistency, right? So we have to trade the market objectively as it is happening in front of us, okay? So we have to look at what is happening to the prices in front of us instead of relying on opinions, relying on market rumors, some theories, or even worse, if you fantasize of what is going to happen, okay, in the market. So it's very important to look at the markets objectively, okay? And the other thing is go where the market wants to go. Always trade with the trend, okay? Don't go against the market. If the market wants to go up, you follow it, okay? If the market wants to go down, you follow it, okay? If the market wants to go sideways, then you use a strategy to trade a sideways market. Okay, understand that you do not need to be right all the time to be profitable, and this is very, very profound. Okay, a lot of people feel that you need to be right all the time to make money. That is actually no, right? You need to have a trading edge, a positive expectancy. That is more important, okay, than being right all the time. And expectancy is a matter of combination between the win percentage of your trading methodology as well as the risk reward of your trading methodology. And that comes under risk and money management, right? We will cover some of that afterwards. So this is a very important point. Trade the reality of the market. Concept number 3, leverage. Okay, if you're trading futures, leverage can make or break you. Okay, always understand that leverage is a double-edged sword. Okay, it cuts both ways. Now, the seasoned traders love leverage. Okay, because the leverage, basically you use a smaller capital and can hold a larger exposure. So futures is a leverage trading instrument. Okay, due to the smaller capital required compared to the actual notional value of the futures contract. I'll give you some examples of this, right? So leverage can greatly enhance your profits, okay? So if your leverage is 10 times, a 1% move in the underlying is a 10% move in your margins or in your deposits, okay? So that greatly enhances your profits. But then it can also enhance your losses. So be very, very careful because leverage is a double-edged sword. Okay, so as a professional trader or one who's a skilled trader, you need to take advantage of leverage, but never let it work against you. Okay, so this is a concept of risk management. You don't want to have leverage work against you. Right, so this is a very important point, which I will illustrate here. Right, so this is margin and leverage. Now, margins are what the clearinghouse or the brokers charge you, which are the minimum deposits you need to have to hold any futures contract or any position in the futures market. And it is actually a small percentage of the value of the instrument. Okay, let's have a look at this crude palm oil, Bursa Malaysia crude palm oil futures contract, right? So the outright margins, the margin is 7,000 ringgit currently, okay? So let's say, for example, if you trade the palm oil now is trading about 4,000 ringgit per metric ton, right? So the palm oil contract is a 25 metric ton contract. So the contract size, 25 metric tons times 4,000 is worth 100,000. Okay, so if you trade one contract of palm oil right now, it's about 100,000 ringgit worth of palm oil. And what are you using? You are using only 7,000 ringgit to move 100,000 ringgit worth of palm oil. Okay, so that's called leverage, right? 7,000 out of 10,000 is even less than how many percent, right? It's even less than 10%. Okay, now KLCI futures. KLCI futures is the index, right? Your outright margin is only 4,000. But what is the notional value of the KLCI you're trading? Okay, so the multiplier for KLCI is 50. So let's say, for example, index now is 1,006 times 50. That's 80,000 ringgit, right? That's notional value. But you're only using 4,000 to trade 80,000 worth. So that is the leverage that is very powerful, okay? And traders like us, we in the futures market, we just love it, okay? Yeah. So, but remember, as we said in the previous slides, it's a double-edged sword, okay? So in terms of margins, it's typically between 2 to 15% of the actual contract on notional value. Okay, so basically, when you put up your margins is not actually to buy the full value. It is actually like a good faith deposit, what we call a good faith money, acts like a performance bond. Okay, that's what the clearinghouse requires to have minimum in your account. All right, so understand this leverage, and leverage actually comes from the margins charge. Okay, critical concept number 4. Okay, keep trading simple. Okay, if you want to have a more sustainable and more robust trading system, your rules for trading must be simple. Okay, because you need to act fast, you need to react fast. You cannot have very complex rules. Okay, so the better your trading system, it's likely to be simple. So KISS is the formula, right? Keep it simple. I wouldn't say stupid. Okay, keep it simple. KISS, the optimal trading plan has to be simple. Okay, simplicity always wins over complexity, right? So but of course it needs to be a logical and rational approach. Okay, have clear rules for entry, have clear rules for stop losses, and have clear rules for exits as well. Okay, I'll cover some of these entry, stop losses, and exits in a moment. What is the fifth concept? Okay, the fifth concept is a very important rule, especially when trading leverage products. You need to trade with a stop loss strategy. Okay, being wrong is okay. It's okay to be wrong because, as we said, we can't be right all the time. But staying wrong is not. Okay, being wrong is okay. Staying wrong is not. Okay, so staying wrong is not admitting that you're wrong. Okay, and don't want to take a stop loss. Okay, this is a very, very cardinal rule in trading. Okay, so know your risk every time you trade, and when it comes to that and it triggers that your maximum risk, you have a stop loss to get you out. Okay, so you always need to define your risk and reward before every trade. Okay, you must know what's your risk and what's the potential reward of that trade. Right, so utilize stop loss procedures. Okay, have protective stop losses or trailing stops in your trading. Okay, always have a stop in case anything goes wrong. Okay, so now the other thing is you must be willing to maximize profits, but also do not let profits run into losses. Okay, this is talking about the profit taking. Okay, you want to maximize profits, of course. Okay, but also do not let the profits run into losses. Okay, that's the most heartbreaking thing, is to see a very nice profit turn into a loss. Okay, never do that. Right. So that's a critical concept number 5. And let's move to the last one, which is also a very important one, is trade with the money you can afford to risk. Okay, your risk capital must be true risk capital. Okay, because this must be money you're mentally prepared to lose it all. Okay, if you cannot lose this money, okay, that means that's not your risk capital. Okay, because I've noticed in my last 25 to 30 years in this business, okay, those who come in with fearful money, okay, fearful money, this money cannot be lost on. Okay, cannot afford to lose this money, is a guaranteed way to lose psychologically. Okay, and I've seen all those who came in with the scared money always lose. Right, so you must be able to walk away from a loss. That's why you have a stop loss strategy, right? Yeah, to minimize the loss, actually, right? So you must be prepared to trade only with money you can afford to risk. Okay, so all those borrowing from outside, stretching out your credit cards, no, all those are not very good ideas. Okay, it must be capital that they are willing to risk. So these are the very, very important 6 concepts, but that you need to know when it comes to trading. Okay, very, very critical in your success. All right, so now let's move on. Okay, to talk about building a trading game plan. Okay, so basically in terms of trading, you will need to have this. Your trading strategy will need to have a methodology. Okay, then you have the money management. That's where you do your position sizing. That's where you do your risk management. Okay, and then the last one is your trading psychology, your mindset, your mental state when you're trading. So you combine all these 3 very important points. This will complete your trading strategy. Okay, so these are the building blocks of a trading strategy. Now, in terms of methodology, there are lots of ways to do it, okay? And this is what you see here on all these words are basically those things that I've gone through over the last 25 to 30 years in this market, right? So market analysis, there are many, many types, right? You can see that you can be a fundamental analysis, looking at economic data. You may love candlesticks. You may look at volume. Some of you look at sacred geometry. Some of them look at the moon cycles. There are even things like that, looking at the moon cycles and how it affects markets. Okay, what do you call that? MECD, moving averages, stochastics, a whole load of different types of market analysis. Right, whatever methodology you use, it must be able to be systematic. That's very, very important. You must have a clear rules for that. Okay, so market analysis is something that sometimes can be very personal as well. Okay, and today at the end of this, towards the end of the session, I was sharing with you the methodology, a simple methodology that you can use to trade. Right? So methodology, there are many. You can pick your favorite. Okay, so in terms of methodology, actually there are two approaches. Okay, there's one called discretionary approach. Okay, where you enter and exit based on feel. Okay, you observe charts. Okay, it doesn't mean that you don't look at charts. You may look at charts, you may read the news, you may research some fundamentals, or for some people they like to listen to hot tips or rumors, or you act on hunches. Okay, so how do you know that you're trading discretionary approach? Okay, if you hear yourself in your head say, I feel I can buy palm oil, okay, or I feel I can short the index, okay. When you hear yourself this word feel, you know that it's discretionary already, because the decision is made by the trader. Okay. But you say, hey, David, what are you talking about? All decisions are made by the trader. Okay. Yes. Okay. The next point I will show you the differentiation between decision made by a trader and the decision made by a system. All right. So remember this. If you say, hey, I feel, wow, looking at this chart, I feel the market's going up. Now, you are a discretionary trader. Okay. And what is a systematic and mechanical approach? That's the second approach. Okay, is rule-based. Okay, rule-based entry and exits. It's very structured, very disciplined, and it's non-emotional. Okay, and decisions are made by the methodology. So that's the differentiation between discretionary and systematic or mechanical approach. Okay, so decisions made by methodology, that means I look at I've designed all the rules. Okay, you've designed all your trading rules, and you look at your chart, and when the setup is there and it triggers, you will execute the order, right? It's not I feel, it's no longer I feel. The system already say buy or sell, and you just execute. Okay, so for those who are starting out, okay, until you have mastered it, until the mechanics of the system is inside you, then you use discretionary because it's already inside you, right? For those starting out, I highly recommend that you use a mechanical approach. Okay, that's rule-based with entries and exits as well. So all the algorithms in the world that are programmed to do trades automatically, they are all mechanical systems, right? They have rules to follow and instruction to follow to execute the strategy. Okay, I would highly recommend that you look at systematic mechanical approach to trading. Okay, and one of the reasons why you can a systematic and mechanical approach is good is because it's easier to measure the results. Okay, you can more easy to analyze the data that you get from your trading, your statistics. You're able to identify where the weaknesses or where are the strengths of the system if you're using a systematic or mechanical approach, right? So there are basically these two types of methodology in trading. Okay, so when it comes to methodology, okay, what type of methodology? The most important part, okay, if you talk about trade entry and trade exits, the most important part is actually the exits, okay? Because anybody can go in the market, right? You just bang a few key and then you're in the market. It's very easy to get into the market, okay? So the money is actually not made when you buy or enter, okay? It is made when you sell, okay, when you exit. Okay, so any monkey can enter a trade. No, he can just key in the keyboard and then boom, he's in the market, right? But how does he take loss, right? Or how does he take a profit? Okay, that's the exit strategy, which is very important, right? So basically, there are three ways to exit. Okay, number one is a stop loss. If a trade didn't go well for you, you have a stop loss there, and it triggers a stop loss, and you're out. Okay, or profit taking, right? So you have a good trade, it goes for you, and you take profit. And the last, of course, there's another way of getting out is if it's not going anywhere, right? You expect the trade to develop, but it doesn't develop. Okay, and then you see, okay, this trade doesn't look good, and you get out. Okay, it's not going in there. So you are preserving your capital for other types of opportunities besides what you're seeing right over here, right? So there are three ways of getting out of the market, right? Either SL, they call it, or the TP or PT, the profit taking, or exit if it's not going anywhere. Right? The most important exit, of course, is the stop loss. Okay, it is very, very important. And I like to emphasize, as actually in red here in my slides, is do not trade if you do not have a defined stop loss strategy. That is extremely, extremely important. Okay, why? Why? Because not all trades will be winners, right? We accept that in what they call that, one of the critical concepts just now, that no one can predictably and consistently predict the market every time. So you're likely to have some times that you're wrong, right? Not all trades will be winners. So your stop loss, okay, your stop loss is a very important strategy to preserve your capital. Okay, capital preservation is one of the most important things in trading, right? Your stop loss preserves your capital for the winners that will come, right? This is very important, right? If you have a good strategy, the winners will come. You just don't know what is the sequence, right? So you may have a couple of losses before the winners come, right? Or you have a win or a loss, win or loss. We don't know the sequence, right? So you have to have this stop loss strategy in order to preserve capital, right? So the tactic is, if you are trading and your system allows it, immediately put a stop loss order after every time you enter the market. Okay, and know your exit. That means know your risk before you even enter your trades. Now, that's very, very important, right? And right at the side here, you can see in the blue is a slight snippet of Victor Nederhofer, one of very, very famous traders who wrote The Education of a Speculator. He said his guru, his guru George Soros, never talk about winning trades one, right? George Soros only talking about the trades that losers only, talk about losers only, right? So listening to the biggest losers, you think they have nothing but winners. So you're saying that those people who lose money, right, only talk about their winning trades, never talk about their losing trades. Okay, so even George Soros, one of the big and famous traders, okay, always talk about what he can learn from losing trades. Okay, so this is very important. Okay, if there's no other slides you remember in this whole night's presentation in terms of live trading with real money, this is the most important slide of all. Okay, so in terms of profit taking, right, you also need a systematic strategy to fight the emotion of greed, right? Not only if you have fear, you also have greed, right? And profit taking, you need to have a systematic of doing that as well, right? So this is the key to your consistent results. Okay, there are various types of profit exits. Profit take exits, it could be fixed dollar, fixed percentage of price, technical stops, or trading stops. Okay, so I may have missed out some points behind that. The different type of stop loss as well. Okay, fixed dollar stop loss, which means that's the risk that you define either in percentage or fixed dollar, and then also technical stops. Okay, so let's move on to the money match guidelines. So this is a quick one, but very concise. Some rules that you want to know. Okay, the first thing, as I say, money management, the first most important rule is preserve capital, and that's the key to the survival, and it is also the key to your prosperity in trading. Okay, always trade with a stop loss. Okay, don't say that David is very long-winded. Okay, this is, I can never stress this enough, always trade with a stop loss. Okay, risk no more than 5% of your trading capital, right? Normally, a lot of traders trade between 1 to 2%, okay? But risk no more than 5% of your trading capital on any trade at any one time. Okay, always calculate your win-loss ratio. This is your risk-reward ratio. Okay, and aim for a two-time profit against your risk. Okay, that's a good benchmark to have, a 2 times win-loss ratio. Okay, this is not your win percentage, okay? This is not your percentage of how many wins in 10 trades. This is your risk reward, okay? So if you are, say, for example, risking 500 ringgit, then if you have a good risk reward of 1,000 ringgit, then that's a very good risk reward or win-loss ratio, right? And use position sizing, okay? I'll cover in the next few slides. Use position sizing. Increase your size when you have profits, okay? That means as your equity or balance improves or increases, you increase your size. And decrease your size is your losses have made your balances lower. Okay, this is a very important rule. This otherwise there's a name for it. It's called anti-martingale, right? There's the other one which is very famous and a lot of people use it. Okay, it's the fastest way to lose your money. It's called martingale. Okay, and this is of course the strategy that a lot of people use in the casinos. The martingale way of gambling. Okay, so if you're using martingale, most of the time you'll be in what we call the gambling style. Okay, so we don't good traders don't like to use that. Okay, good traders use anti-martingale. All right, so increase your sizes only as you increase in terms of your profits and in terms of your balances. Right, so this is a quick and very concise guide to money management. Okay, we shall jump into this very important topic called position sizing. Okay, why do you need to have position sizing? Okay, position sizing is basically varying your exposure, okay, or varying the number of contracts that you trade depending on your account size. Okay, it's very crucial. Okay, it decides how many futures contract you buy or sell for a trade. Okay, the optimal position sizing is basically a balance between too large a size and too small a position. Okay, this is trying to balance it so that it's optimized. Okay, so if the position is too large, okay, so you tend to have a risk that you will make irrecoverable losses, right? You can't come back from some of the losses due to a string of losses. Okay, so if, let's say, for example, if you risk 20% of your balance every time you trade, okay, within 3 to 4 trades you will be unable to trade already because you have lost about 80% of your capital, right? So it's never wise to position size that's too large, because you can never know how many losses you will have in a string of losses. Okay, so that's very, very important. But if it's too small also, then, you know, if you have a good system and you're trading it very, very small, you're not truly optimizing the account profitability. Right. So the rule of thumb is in terms of risk that you take. Okay. It's, as we said just now, between 1 to 2% if you're conservative. If you are more aggressive, or you give a bit more leeway, perhaps 3 to 5%. Right. And later we'll see that for swing traders, because they need to hold their positions overnight. Okay. They will need to give a bit of leeway and room to move. So they probably trade between 3 to 5% of risk against their total balance size. Right? So let's talk about the fixed fractional or fixed risk method of position sizing. Okay, there are a lot of position sizing strategies available. Okay, but this is one of the most popular and a very logical and very rational way of doing it. You basically trade the number of contracts according to a fixed fraction. Okay, so how does it calculated? I will show you. Okay, so it decides how many contracts to trade based on the risk. Okay, trade risk. Okay, something that the risk is the same percentage. Okay, this risk we're talking about is the same percentage or fraction of account of equity each trade, right? So we say that in swing trading, traders typically risk between 3 to 5% of the account balance. Okay, so if you have 100,000, okay, so your fixed risk is 5% or 5,000 of your full capital of 100,000. Okay, and then you must understand this very important point, which is trade risk. What is trade risk? Trade risk is the dollar amount of risk taken for each trade, which is basically your stop loss. Okay, and your stop loss can be defined as a technical stop loss as well. All right, so let's move on and see how to calculate the fixed risk method of position sizing. Right? Okay, so we assume you have 100,000. Okay, so if you're trading DVTC, okay, Brusa is so kind to give you virtual money of 100,000, right? I think I'm correct. 100,000. Okay, so let's say you trade swing trading, and we say, okay, swing trading, I want to trade the maximum out of the risk that is available. So I trade 5% risk. Okay, so that's 5,000 ringgit. Okay, so your stop loss, now this stop loss is depending on how you trade your risk. So if you have a technical stop loss and your stop loss is worth 500 ringgit per contract, okay, you may be trading multiple contracts, then this is the formula that you go with. Okay, so the number of contracts you trade, okay, for a fixed positions size example is the account equity multiplied by the risk percentage, okay, which is the 100,000 multiplied by the 5%, which is 5,000, and divided by the trade risk. Right, so if each of the trade risk, each contract is worth, say, 500. Okay, so 500 is basically like a 10-point in FKLI, right? So if you have a 10-point stop and it's 500 ringgit, so how many contracts you trade? You divide that by 500 and you get the number of contracts as 10. Okay, so now remember just now we said that if your account size move higher or increase, okay, so let's say, for example, you're good at trading, you're successful, you caught a very good trend, and now you have, say, you have 200,000 now in your account. Okay, so how many contracts do you trade? Okay, so 200,000 divided by 500, okay, then you will trade 20 contracts, right? Now, what if you had a string of losses and now you are perhaps at say, okay, make it easy, 50,000 ringgit. Okay, so 50,000 ringgit, what is your, and your risk, trade risk is still the same at 500. So how many contracts do you trade then? Okay, So you will trade what do you call that? Less than that. Okay, you will trade 5 contracts. Okay, so that's how you calculate your number of contracts. Okay, does that make sense? Okay, so let's move on. That's a fixed fractional method of calculating position size. Okay, so this is one of the most popular or most popular way of calculating your position size. There are other ways as well. You can go and check it out. Okay, and one of the good money management books and position sizing books is written by Van Tup. Okay, Van Tup is a Bible. If you like, if you can't sleep, okay, and like to read, okay, then you read Van Tup's book on position sizing, okay, few hundred pages. But it's a solid Bible for position sizing. Okay, so if you have any questions, you can always put your questions later in the chat box or the Q&A. Okay, we move on. Okay, now we get to the exciting part. Okay, trading FCPO. Okay, these 2 Bursa Malaysia contracts using the ABC methodology. One of my favorite simple strategy that a lot of people have found to work for them, and including myself. Okay, so let's move on. Okay, before we get into the trading methodology, just get you a bit familiar for those of you not familiar with the Bursa Malaysia contracts. Okay, we're going to talk about the 2 very active contracts. The most active contract on Bursa Malaysia derivatives is the FCPO, which is the crude palm oil futures contract. We saw just now that it's 25 metric tons. So every time you trade one contract of FCPO, you're trading 25 metric tons of crude palm oil. Right, and this minimum movement is 1 ringgit. Okay, that means it's quoted in metric tons per metric ton. So currently it's about 4,000 per metric ton. So every single 1 ringgit move, okay, that's a minimum move is 1 ringgit. And because it's 25 metric tons, every time it moves 1 ringgit, each contract that you hold, it's moved by 25. Okay, it moves up and down by 25 ringgit. Right, and this contract, of course, be careful. Those of you who trade the spot month, okay, I'm sure your broker, won't let you trade spot month. It's a physical delivery product, okay? So salah, if you forgot and then you get tendered, you are tendered, 25 metric tons of per contract of palm oil. So be very careful. Okay, so normally we don't trade palm oil on the spot month. We trade the 3rd month. The 3rd month of FCPO contract is the most active month. Okay, although there are so many months that are tradable, but the 3rd month is the reference and the most active contract. Right, so this just to get you a short primer on FCPO. Next, we go to FKLI. Of course, FKLI is the futures contract and on the KLCI, the top 30 stocks on Bursa Malaysia. Okay, and the contract size is FBM KLCI multiplied by 50. So every single point on the index for the FKLI is worth 50 ringgit. Okay, but it's quoted half point. It's quoted 0.5 index points. So the minimum, absolute minimum move is 25 ringgit as well. Okay, so for the KLCI, you can't deliver a basket of shares, so it is what we call cash settled. So at the end of the month, if you hold the contract, then you will just knock off by cash settlement. That means the profit and losses for the last trading day will be credited or debited into your account. So there's no physical delivery of a basket of shares. Okay, so this is a quick introduction to the 2 most active contracts on Bursa Malaysia derivatives. And now let's go in to look at how we can use ABC methodology. Right? So what are these ABC entry and exit system? Okay, so these are the characteristics. It's very simple to identify. Yes, it is simple to identify, but you need to train your eye. Okay, initially you may not be able to see the setups until you have trained your eye to look at that particular pattern. Okay, because it's a pattern that you need to recognize. Okay, so it doesn't really require sophisticated technical analysis software. Basically, you need a simple bar chart or candlestick chart to show you the high, lows, and all that. Right? It's quite easy to master. I think if you practice within a week, okay, for those who are joining the DVTC, before the August 1st start, okay, you should be able to master the ABC already, right? These 3 weeks coming. Okay, and what it does for you, it puts the ABC entry and exit system puts you predominantly in the prevailing market trend. Okay, except unless it goes sideways, right? You will be trading with the trend, and that's very important in terms of swing trading, right? So you want to follow that medium-term trend up and down, right? So you can also catch, because you can catch those turnings, right? You can also catch those early reversal points, okay? Early trend reversals, you are also be able to catch, okay? And it's very versatile. Not only can it be used in swing trading, I use it for short-term day trading as well, and you can also use it for position trading. So it's very, very versatile, right? Because it's part of the fractal system of market structure, right? So this ABC is a simplified method of looking at the structure of the market, okay? So without talking so much, let's go into it. Okay, the ABC trade signal. This is how a buy setup comes. Okay, so you have a market that's been trending down. Okay, these are bars. It can be candlestick or bar charts. Okay, so the bars come down and then form a low. Okay, it forms a kind of absolute low, and then of course markets don't always move down in a straight line. Okay, it retraces. It retraces to B level. And then, it starts to try to move down to its the prevailing trend. Again, this trend is down. Okay, so it goes down to C, but then the C low doesn't go and break the A. Okay, it doesn't make what we call a lower low, right? It doesn't break A. And then it goes up and trigger and trades above B. And this is your buy trigger signal, okay? And so the action to take is your buy one tick above this B level, okay? So let's say, for example, B is 1,200. Then when it triggers 1201, okay, you will enter an order to buy the market. That's your signal to go long, okay? That's your signal to go buy. Okay. Another pattern is it can have more bars. Okay, it doesn't have to have this only 3 bars. It can have more bars in between, right? And if those who are familiar with the system that I teach, if you have 5 bars, this is actually a fractal. It becomes a fractal. Okay, it's part of market structure, right? So you can have more bars in between. In fact, you have more bars in between. The signal may be stronger when it breaks out through B. Okay, so this is the ABC trigger. Okay, so you can see here you need to be able to recognize by your eyes. Okay, there's no indicator to show this. You have to recognize by your eye. All right. So the next slide, let's go down. It's just to draw out the wave for you. Okay, so it comes down, make a low, makes a high, come down, doesn't make a lower low, and breaks this the previous high at B. Okay, that's where you go long. Okay, so this is a buy setup. How does a sell setup look like? Okay, before that, we have examples. Okay, this is the ABC buy signals from 26th of March this year, and this is a nowly chart. Okay, so from this period of 26 March until 5th of April. Okay, so here are some of the ABCs that I identified for you. There may be some other ABCs that I didn't identify, but for this particular example, I'm only showing you the buy signals. Okay, so I'm marking those B levels, okay, which are the trigger points in a dotted green horizontal ray. Okay, so you can see over here, there's an A, which is a low, then the markets retraces to B, then comes back down, but C doesn't go below A. Okay, if it goes below A, then it invalidates the signal. Okay, then subsequently go up and break B. Okay, so the action to buy is actually this bar right over here. If you can see my cursor right over here, which it breaks through, and this is where you actually take action to buy. Okay, and you can see other subsequent waves going up, and you have more ABCs formed. The C can also now act as an A. Of course, this original can act as an A for this B. Okay, so you can have this red A followed by a red B and a red C. Okay, this ABC. So this formation has more bars in between. Okay, now if you are very acute in your eyesight, you can see this is an ABC as well. Okay, right over here. There's another signal over here which I didn't mark. I just marked something that's easier on your eye. Okay, and with more bars. So A, B, C, and this is your trigger, and was triggered on this day of this green bar. Okay, and this green bar itself also actually became an ABC. If you are very acute, you can see an ABC as well, right? So this one you must train your eye. Okay, I've been doing this for like the last 25 years using this, right? So my eyes is a lot faster, but you need to train your eye to see it, right? All right, so here's another ABC for you, a more obvious one, okay? And then you see how it triggered, and then it continued to move up. Okay, the red ones are what we call the red fractals. This is an indicator from Bill Williams. You can use that. The fractals are also ABCs as well. These are the fractals are the Bs and the As as well. So it's a guide as well. Okay, but there's a finer because the fractal needs 5 bars minimum to form, whereas the ABC only needs a minimum of 3 bars to form. Okay. Later we'll see these are actually sell signals. Okay, so these are the buy signals based on the FCPO hourly chart. Okay, we go to another one. This is period between February 26th of this year, right? This is also a 60-minute chart, and you can see all these examples right over here. Okay, by the way, you can always review, go back to this video. It'll be put up in Bursa DVTC page. Okay, you can review this. Okay, don't worry if I go a bit fast. Okay, you can always review this again. This session is recorded as well, right? You can see the buy signals here marked in green rays. Okay, there are still other ABC's signals over here. I'm just showing you the more obvious ones, right? You can see all the buy signals and how it trends. Okay, here there are some sell signals actually. Okay, this will be some signals to take profit. Later we'll see, and then it continues the uptrend. Yes, the ABCs that is broken up over here. Okay, so these are basically showing you some of the ABC setups for FCPO 60 minutes. Okay, then we have the FCPO daily. Of course, daily charts, you will have less signals. The hourly charts will give you more signals. The FCPO daily charts will have less. And this is for 2024 until May, right? You can see the buying over here. Okay, the ABC is triggered. I didn't mark the alphabet, okay, but all these green are the B's, right? So the A will be here, the B will be here, the C will be here, then after that it traded. Okay, of course the ABCs can come in between as well. Right? If it comes in between, then you will have an earlier signal, right? A, B, C right here, and it triggered a bit earlier than this particular signal, right? When it triggers multiple B's, then it's multiple confirmations of the trend upwards. Right, so here we're on the way up to here, it actually triggered 1, 2, 3, and 4 of this. Okay, otherwise we call this as fractals. There are 4 fractals that actually took out on the way up. Right, so that basically show you how strong trend to be able to take out all these highs. Right, so this would have been a great trade. Okay, in the periods between February and April of this year. Right, if you have caught these fractals, then we have nice profit. Right. So now let's move on to some examples on FKLI, right? These are the ABCs as well. Okay, you can use the video to review this, right? So because of time, I'll need to go through this, right? But just to show you some examples of the ABCs on the FKR daily chart, right? So FKR did a very good run this year, and this is from December of last year. You saw how many buy signals that was triggered, right? So if you're able to take some of these signals in FKLI and really hold it, of course, depending on the time frame, right? If you're a position trader, right, you will have a nice setup and a nice profit as well, riding this wave up. We move down to the FKLI 60 minutes. You can see this, the signals on the 60 minutes as well. This one I've marked the ABCs, right? A, B, C, then this is A, B, C array here, right? So all the ABCs you can see. Some of the C's also become A's as well, right? Okay, let's go on to what is the sell setup. Okay, the sell setup is pretty similar to the buy setup, but it's just a mirror image on the other side, right? So market makes a significant top or A, and then comes down to B, and then C. The trying to move up to the trend again, but doesn't succeed in breaking A, then comes down and break B. That's your signal to sell. That's a sell signal in terms of the ABC signal. And this is another example with more bars. Okay, so you sell the breakout of B minus 1. So it needs to break 1 tick below B. So let's move on, look at some examples again. Okay, this is with the wave drawn onto it so that you can see the wave structure. Okay, so there you go. This is FCPO 60 minutes, all right? So you can see I've drawn the ABCs for you. These are sell signals in red ray, red horizontal ray. All these are the ABCs, okay? ABC. So you need to practice. Yeah? This is a skill. As I said, trading is a skill. So reading this chart using the ABC pattern recognition is also a skill that you need to acquire and practice. So once you practice, it'll be what do you call that? Deeply ingrained in you. So every time you look at chart, you can see all the ABCs. Okay, I instantly can see all of it because I'm so used to looking at this. Okay, another example. We use the FCPO 60-minute again. Okay, this was since April of this year, so a lot of selling opportunities. Okay, if you have caught this, you will have made quite good profits. Yeah, you see, it went from 4370 to 4105. That's a good 200 over points in terms of profit. Excuse me. Right, more than 200 over points in profit. Right, one point is 25. Remember FCPO. 200 points times 25. You can do the maths. Okay. So let's move down to some of these are some legacy ones from previous year. This is in 2020. You could see the ABCs, right? These are just examples for you to refer back when you revise. Okay. I will encourage you to relook at this the video once it's posted up again, right? So that you can revise this lesson. Okay. So these are the selling on FKLI. Okay. These are the short examples on FKLI. I hope to get some live charts later as well because 9:30 Bursa Malaysia opens up the live trading for a night. Okay, this is the FKLI 60-minute. You see the sell signals on the red bars. Okay, those are the Bs. A, B, C. Okay, A, B, C. You gotta pardon me because I've looked at this for so many years already, so it's automatic for me, right? So for those who had untrained eye, you need to practice a bit. Like A, B, C, right? There's even an ABC right over here. There's a sell signal right over here, which I didn't mark. Okay, right. So sell signals over here. Okay, so this was from June of this year, 60-minute hourly charts. Okay, you can see that if you catch the early reversal right over here, you have really nice, decent profits. Okay, so this is the rules of ABC in words. Okay, you initiate buy when it trades above B. Okay, that's obvious. We say that. I think we don't need to repeat this. And the sell signal setup. Okay, when it breaks below the B. Okay, then you sell. Now, thing to note is this. The more time bars, okay, the more bars in between the ABCs, the subsequent breakout can be very good potential in terms of the move. Okay, because it's broken a kind of like a consolidation, okay, in terms of in between the Bs and Cs, right? So again, remember the ABC setups can be identified for any time frame, okay? In this presentation tonight, this evening, we're talking about swing trading, but it's applicable in day trading, it's applicable in position trading as well, okay? Because this represents the fractal nature of markets, which is the structure of the market. Right. So how to put stop loss? Okay, the question always comes, how do I put a stop loss? Okay, so let's say, for example, you have bought the prices B+1 right over here. Okay, you have two choices. You have a conservative stop or you have a more aggressive stop, right? If you want to have a more conservative and tighter stop, then you put your stop below C, one tick below C, right? If you want to give the market a bit more leeway, right? If your system or your 5% risk that you're taking can give you more leeway, you can put it at A, right? Right over here, A-1. Okay, so that's how you put a stop loss for a buy position. And for a sell position, right, that you sold, let's say, for example, at B, then you will put your stop loss above C+1 or A+1. Okay, this is similarly on the right, another example. You sold B-1, okay, markets traded through B-1. Then you will put your stop at C+1 and A+1 tick. Okay, that's how you put your stop losses. And when you're using position sizing, look at the risk from here. Let's say, for example, you're using C as your stop loss and you sold. Then look at your risk between C and your sell price. Okay, so that's your defined stop loss strategy. Okay, you can pre-calculate, actually, when it's going to trigger because you know the distance between B and C. You can calculate that and then you can calculate your position size. Okay, so for example, between this stop loss and your entry price, if it's 500 ringgit, then you use your position sizing to actually, calculate your stop loss. Okay, move on to live setup. Okay, let's go to live setup. It's 9:30. let's see if we can see some live chat. Let me share my browser. Get into sharing my browser. Hold on a second. Let me bring up my browser and some live chats. Okay, I hope you can hope you can see my live chat here. This is crude palm oil. Okay, this is an hourly, right? So what's the most recent signal? Okay, so if you look at this, let me draw for it so that's a bit easier for you to see. Okay, all right. So where's the ABC? Is right here, right here, right here, and then the break. Okay, so it broke. Okay, so this is the break level. Okay, this is the B. Okay, this is the B. Let me draw it for you horizontally. Okay, this is the B. Okay, so it broke. So you currently have initiated a sell signal, and the order has been triggered for a sell in terms of palm oil on the hourly chart. Okay, so if you move back to the chart, you can see all the buy signals right over here. Right, this is the ABC to buy right over here. There's another one right over here. Okay, you know, I'm I'm fast because I see it all this like right over here. Not so for this, right? There are other buy signals right over here as well, right? So that's for palm oil. Okay, it's currently market is open and trading. Okay, so it's trying to recover a bit from the sell-off in the afternoon. All right, so let's look at FKLI to see what we have for FKLI. A quick example before I pass this session to the other speaker. Remember, we still have Q&A at the back, so put the questions up. Right, this is for the Bursa Malaysia, okay, daily chart. Okay, so what do you see from here actually, what is the latest signal? Okay, the latest signal, of course, is recovering from losses. Okay, so the daily chart showed us ABC sell signal, right, actually over here, right, and another one right over here. Okay, so you had the trend come off on a correction. Last few days have been rather strong as well, right? So you see whether any ABC buys around here. Doesn't seem to have any buys. Okay, so it may trigger some of your stops as well for this particular, because the move right over here, the last 1 week has been very, very strong. Okay, but you can see right over here as well, you know, if you were long the market, right over here, you had a lot of buy signals, right? On the daily chart, it had a lot of buy signals, right? And it's been a long buy signal for a long, long time since last year, right? Okay, let's look at the hourly to see anything interesting on the hourly side. Okay, so hourly, you can see you are able to identify on the 27th of June various signals right over here. That means this okay, there's a buy signal on hourly right here. Okay, there's actually here there's another one. Okay, if your eyes are most astute, you can see one, right? So you can see you can actually get in on a very, very good entry level, right? When the trend starts, a reversal starts, you can actually get in at a very good level. Right, so these are your live charts. Let me now get back to my slides, okay, which I think I've completed basically my presentation. I will now pass. Okay, next is Q&A, but we'll take it after the speaker. So let me pass this session back to Shane. Thank you all for your attention. Shane.
Thank you so much, David, for sharing with us about AVC trading strategy as well as futures contract and the critical concept about futures. So we would like to hand over the session to the next speaker. So maybe invite the Assistant Vice President of Affin Hwang Investment Bank, Mr. Lim Eng Wee, to talk about Affin Hwang's offering as well as why you should join Derivative Virtual Trading Challenge 2024. Over to you, Mr. Lim.
Okay, guys, can you see my slide?
Yes, perfect. But you have to
Okay.
go to the presentation mode.
Yeah, is it a presentation mode?
No, not yet. This is PowerPoint mode.
Really? Okay, one moment.
Yes, fantastic.
Okay. Let me introduce DVTC, which is Derivative Virtual Trading Set Challenge 2024 to you guys. Okay. I'm one of the futures dealer from Affin Hwang Investment Bank. Okay, now let's move to the disclaimer. For today's presentation, it's solely personal opinion. It's not any buy or sell recommendation. So you you guys have to responsible for whatever decision that you guys make. Okay, first let me introduce Afifa Investment Bank. Actually, Afifa Investment Bank is founded in 1970. And you can see from here we are the top broker in 2023. We have won numerous awards. Okay, these are the products offered by Bursa Malaysia Derivatives Berhad or BMD. You can see that there are four categories: commodities, securities, equities, and financial. And you can see that the top product is Groupama Futures and FKLI, FTSE Bursa Malaysia KLCI Index Futures. Okay, now let me share with you guys for Derivative Virtual Trading Challenge 2024. Right now, the total price money can is increased to 87,000 ringgit. The challenge period is between 1st to 30th August 2024. You can join right now. This is the link for you guys to go to the DVTC webpage. The objective of DVTC is to raise awareness and generate interest in derivatives trading among the public through knowledge sharing and experiential learning, and to build capacity by promoting careers in derivatives to university students. So these are the three expected outcomes from DVDC: to increase interest among the public on Malaysian derivatives market, and increase awareness of BMD's licensed future brokers and services available. Last but not least, increase awareness of futures trading and career opportunities in derivatives market among university students. Okay, this is the timeline for DVTC 2024. Now is the familiarization period. So you guys can register and try to trade. No worry, this is just a familiarization period. It won't be count. So you can just test it out, test the features, test your trading strategies between now until 25th of July. Then it pause for a while for the system vendor to calibrate the platform, and then the real challenge will start from 1st to 30th August. Then the challenge will end, and you guys will be notified by 2nd October. And the prize giving ceremony is 19th October. So this the features of the web page. You can click here, step one, click the link here to register before by 25th July 2024. I will encourage you guys to try it out now so that you can familiar with the DTS simulator platform. It's a web-based platform and it's available in mobile apps as well. After that, you'll receive confirmation via email. Then you can log in into DTS to explore the platform, and you can gain your trading knowledge and skills at the familiarization sessions. The trade on DTS from 1st to 30th August with 100,000 ringgit virtual capital. And your target is to achieve the highest account balance to win the campaign. You can also click the FAQ here to gain more information on this campaign. These are the 5 products that offered in this trading challenge: FCPO, FGO, FGLD, our Gold Futures, FLI, F4GM, FTSE for Good, Bursa Malaysia Index Futures, and the newly launched products FCNH, Mini USD CNH Futures Contract. So this is how the registration webpage looks like. You have to key in your information, and the most important thing today for me is you guys have to key in our referral code AHIB 2024 in order for you guys to register under us. Then you will get an email from the system vendor, and you can click at the link to access the web-based platform, or you can click the link to download your mobile apps. If you have any questions regarding the trading platform, let's say it's like you have any technical glitches, please feel free to email the system vendor Quick Trading or call them at the number that they provide to you. You can have a look at the contract specification of the products that available in this trading campaign. Just go to Bursa Malaysia webpage, and then you go for you look for the crude palm oil futures under derivatives. Okay, besides that, if you're interested to know about commentary of the market, you can scan the QR code here and join our Telegram channel. This written by us. You can have a look on our daily commentary. Okay, this trading hour. For your information, T plus one session is not available on DVTC Trading Challenge. The Trading Challenge will end by 6 p.m. on 30th August. Everything is only during the day session. You guys can have a look. Mm. This is how the webpage platform looks like. There's a lifetime chart, and on the left is your price code. On the middle is your price ladder. You can use it to execute orders. It's simple and fast. You guys can have a look. If you guys still have any questions on how to utilize the BTS simulator platform, you guys can please feel free to contact us. This is how the mobile USD apps looks like. Okay, this is the daily trading statement that will be generated from QSD. It will shows your capital, the trades you have done, and your P&L. This is just a dummy one that we previously simply raised it. Okay, benefits of DVTC, you can experience real-time trading, sharpen your trading and analytical skills, and last but not least, identify the market trend. So now let's move to the prices. The prices for DVDC are all cash prices. Besides that, this year you guys will get full day advanced futures trading workshop worth 4,800 ringgit, and there's 1.2 gram of digital gold from Bursa Gold Dinar. The grand prize, the champion will get 10,000 ringgit cash prize plus advanced futures trading workshop. For runner-up is 7,000 ringgit cash prize. Yes, again, plus advanced futures trading workshop. And the runner-up is 5,000 ringgit plus advanced futures trading workshop. So there will be 20 prizes, 10 consolation prizes for 1.2 gram of digital gold from Bursa Godina. And the one to the 10th place, you will get cash prizes plus advanced visual stream workshop. Okay, this is a summary of DVTC 2023. You can see that most of the participants are male, and the based on age group, most of the participants are between 25 to 44 years old. And we can see from here, 68% have no experience in trading futures and options. So it's not a problem for you guys to start. You guys can really learn from here. So this is a feedback based on the 105 submissions for last year DVDC. And majority will enjoy the experience with DVTC, and 82% will recommend to their friends and family members. And most of them can apply the knowledge and skills learned from DVTC campaign. And 78% feel that they want to start trading futures in the near future. This is these are the photos for the winners in 2023, and you guys can have a look at the link here. They share the stories and strategies here. So these are our contacts. We are located at Taman Tun. I'm Engvi. We are all dealers here. You can contact us through the phone number listed here or through the email. Okay, that's all for my presentation.
All right, thank you so much, Engvi, for sharing about DVTC. So if you want to test out your trading strategies in futures, then I would definitely urge you to participate in this derivative virtual trading challenge, because it provides you a risk-free environment to trade futures, to gain a first-hand experience in trading futures without risking your hard-earned money. So after typically this QST platform is not provided for free. If you want to learn trading, it's not provided for free, except during this trading challenge, where you can get to use this QST platform for free, because Bursa has already sponsored this trading system for you. So like, if you have any questions, ask our speakers today, please write them at the Q&A box. All right. So the first question here is that I did not key in my referral code when I register for this event. What is the difference?
This I have to check with Pusa personnel. But this, if you don't key in referral code, you won't be tagged under the participating brokers in this campaign.
So in other words, they don't have an affiliated broker partner,
Yes.
correct?
Yes.
They can still
Yes.
join the contest, just that they may not be tagged to one broker.
Yes.
Okay. So what happened to the contracts that are still open after the competition end?
They will settle it based on the last day's closing price. Means they'll calculate your P&L using the last day's closing price.
All right. For those who want to revisit this video, right, this replay, you can visit our YouTube channel, or you can go to www.bursamarketplace.com/dvtc for you to check out all the replays, right? So, David, just now you mentioned the book by Van Tup, right? Could you tell us the name of the book?
Okay, you Google Ventup and position sizing and money management. I think you get the name pop up. Offhand, I don't have the exact thing. It's on my shelf somewhere on my right over here. Yeah, just key in position sizing Ventup, VANTHARP, and you'll see it. Google up. Okay. Sorry, I can't remember exactly the title. Yeah, but Google those two words and it's gonna pop up straight.
All right. Thanks, David. Now, there are a lot of questions that ask about fake breakout. So for ABC buy signals, how do you determine if this is going to be real or fake breakout?
Okay. The fake breakouts, there are two ways to solve this. Okay. One way is the trading psychology way. Okay. So we saw, I think it's critical, what do you call that? Lesson number 2. Okay. You have to accept that in any trading systems, there will be times that you're wrong. Okay. So a lot of traders can't accept false breakouts because they want perfection in their system. Okay. So that's one of the things, right? So if your system is a 60-40%, 60% win, 40% loss system, right? So you expect 40% of your signals not to be correct, right? So 40% of those signals could be false breakouts, okay? But there's another way to solve it, of course, okay? If you find yourself gotten broken out a false breakout 2 times, right? 2 times at near the same level, then you have to say, hey, okay, My ABC method is a trend following method. Okay, it looks at the current trend of the market is going sideways. Okay, so you will try to avoid trading the next couple of signals. Observe, okay, over the next say 20 bars whether it forms a trading range. Okay, then when it forms a trading range, then you put a support resistance line against the top part of the say the B that's highest and the lower part, the B that's the lowest, and then you look for a breakout, a convincing breakout across this channel. Okay. Otherwise, the other way to do it is to have to trade the second B signal after the first is broken. Okay, so there'll be on an uptrend there'll be a couple of Bs that will be broken. Okay, so you don't trade B on the first reversal signal, you trade the second one. Okay, so there are various ways to solve it. If you take the second B signal, then you complain, no, I should have taken the first one. Okay, because the first one always give you the best trade placement. Okay, so as the more filters you put in, okay, you can put in more rules. That's why I say keys, keep it simple, right? So that keep it simple, sweet. Thank you for that. KSS definition. I saw the messages now. So the more rules you put, the more complicated your system will be. So it's always what we call a trade-off, right? You trade the second B signal, you give up the trade placement, right? Because you want confirmation. So you lose out that particular move because you want confirmation. So it's a bit of you need to balance your priorities, okay? But always remember this. Don't try to go for perfection in terms of your statistics because it's impossible, right? You tweak one thing, the other thing will change, right? So if you tweak one thing for more confirmation, you may lose your risk reward in terms of the returns, right? So it's always a trade-off, right? I hope that answers the question for the gentleman or lady who asked that, or many people who asked that.
Yes, thanks, David, for sharing your perspective. The next question is, just now you mentioned that FCPO, the most active contract is a third month. So what about FKLI? Which month is the most active contract?
FKLI, you normally trade the spot month, which is the current month, right? So if it's now currently July, then July is the most active month. Okay, so for index contracts, normally they trade the nearest month, which is the current month you're sitting on.
Right. So for the ABC trading strategy, does the breakout success rate depend on whether it is a big breakout or is a small breakout?
So it depends on what you mean by big or small, right? So say a simple, let's define a bit, simple breakout compared to say a complex breakout, right? So the complex breakout, just now we talked about the possibility of it being a range and breaking out of that range, okay? So in a complex breakout or a range breakout, okay, technical analysts will tend to say that if it breaks out, say this length, okay, I don't know where you can see, okay, if it breaks this length of the size of my head, okay, then it'll move this length as well, right? So people like the range breakouts because after a long consolidation, when markets decide to move and moves decisively up, okay, and after it's rested for a long time, you see a very, very big move, okay? So that I think probably will define what, I hope that defines what you mean by a big breakout, okay? Or unless you say that's a big breakout in terms of the length of the bar, right? So, but I'll see it that way, simple or range trading, okay? Both can be effective, okay? Because some trends turn on a dime, okay? Some trends need to go on consolidation and gain strength or form a base before it comes up. Okay, so both of them against the rules are the same, right? So if you want more confirmation, as we said just now, you add more rules, but don't overcomplicate the system. Back to you, Shane. I hope that answers the question.
All right. Thank you so much, David. So for the DVTC contest, right, can we hold the position overnight, Mr. Engwi?
Yes, no problem. It's like live trading. It depends on your strategy, whether you are a day trader or you like to hold position.
Yep. So for this trading challenge, it only lasts for 1 month, right? So what kind of trading style or any trading tips that you want to share with us?
Try the strategy that suits you the most up, and you can try to take some risk because it's not your real money. Try to maximize your profit lah. What I can advise.
All right. So David, the next question is for you. So for ABC strategy, what is the risk reward ratio that you use and what is the expectancy of the strategy?
Okay. In this, excuse me, it's about it should give you about 60% win rate. 2-to-1 risk reward is quite common. I think you can get that, as you can see in the charts. Okay, prove it to yourself. Have a look at it. Right, look through some of those examples that you saw. Right. Also look at some of those that actually had consolidation. Right, you will have less risk reward ratio or worse off risk reward ratio at the ranges. Again, that is the weakness of a trend following system, right? But you must be aware always, right? But the 2-to-1 or more is highly possible if you catch the turning point. Okay. But one thing to note is this, just a tip, right? If you're on a uptrend and you're seeing that yourself, you are taking the fifth B breakout, okay, of the ABC, fourth or fifth, okay, you will tend to know that that is almost the end of the trend. Okay, it's like in any trend, okay, otherwise called the fourth consecutive fractal breakout on the upside. That is the end of the trend. Okay, so if you are right at the end of the trend, say on the buy side, then you try to look for the reverse signal rather than continue, because the momentum could have been exhausted already. So this one extra tip on top of what we said in the charts just now. I hope it answers the question.
Yep. That's all the time we have for Q&A. Maybe you just do one last question, yeah, David. So for those that who want to excel or succeed, become a winner in this challenge, right? What advice would you give to them?
Okay. Okay. I think Ingrid gave you a good indication. Okay. Catch a trend. Okay. Look through all the various charts that you have and various products traded on Bursa. Catch the trend, because you don't know, right? Which market will go into a sideways market. Okay. Catch the one that is most prospective in terms of the trend, and then as the what do you call that? A trend goes for you, continue to be able to add positions. Okay, to size up your positions according to the position sizing, some of the tips that I provided to you, right? So you can see your ability to size up as your profits power. Okay, that's one way to maximize your profit.
All right, thank you so much for your advice. So for those of you who are thinking to practice, futures trading for the first time, or if you're not first time, futures trader, you want to test your skills in this futures trading virtual trading challenge, you may join this DVTC 2024, where we have a lineup of amazing prizes for you to win, right? So from digital gold to advanced future trading courses, okay, provided by new Pinnacle Trading Academy, to cash prizes that you can win in this DVTC, right? So there's no participation fee. So when you enroll into this session, you can, key in Afin Huang's investment bank referral code so that Afin Huang can handhold you and to emerge as a winner in this contest. All right. So with that, I want to thank all of you here for spending your 1.5 hours with us today. Hope that you have learned and gained enormous value learning from David and Ingrid about futures trading and also the DVTC challenge. With that, thank you everybody, and hope to see you